Hey guys, it's Aman
and Christina
from Our Rich Journey. It is the end of June 2020 and we are taking you guys back into our stock portfolio to share with you the performance of the portfolio. If you've been keeping up with this series, you know that in March of 2020, we invested $5,000 into the stock market, and ever since we have been adding an additional $1,200 to this portfolio each month. And this has been a series where we show you how everyday investors invest in the stock market for financial independence. So each month we go over our portfolio and share with you how the portfolio is performing, but we just don't stop there. We always go a step further and answer your investment questions. And this month we have a very special question that we are going to address. And the question that we're going to address is it a good time to invest right now? And our answer comes down to market timing.
So we get this question all of the time. It doesn't matter if the stock market's doing well, if it's doing poorly. We always get people asking us whether we think it is a good time to get started investing in the stock market. And for us, it all comes down to market timing. So that's what we want to focus on in this video. We want to talk about what market timing is, but we also want to focus on a specific study that shows how market timing can be very damaging to a portfolio. We also want to talk about other ways that market timing can sabotage your portfolio. And then we want to talk about alternatives to market timing. And then, of course, like we do in every video in this series, we want to open up our portfolio for you and show you how it's been performing.
And we think this is a perfect time to address this question because in June, there was a big one-day drop. And a lot of people got scared based off of this one drop. So if they were investing or if they were planning on investing, that drop called that decision into question. And so we think this is the perfect time to address market timing.
So like Aman said, we do an update on this video series every single month. So if you're interested in following along with this series, make sure you subscribe. Also, if you're interested in finding ways to make money, save money, and invest money, that's what our channel is all about. Aman and I reached financial independence in 8 years, and we share our journey on this channel. So if you're interested in learning more about ways to make, save, or invest money, make sure you subscribe.
So let's get into market timing.
Market timing is when you invest in a stock or the stock market when you think it's at its lowest point, and you stay invested, and then you sell your investment when you think it's reached its peak at the top of the market. And then after you sell, you wait until the market gets to its lowest point before you begin investing again. At that point, you buy back into the market, and you continue to buy and sell like this throughout the course of your investment lifetime.
Now, this is virtually impossible. No one has been able to do this for a consistent period. Yet, even after knowing that, people still try to market time. And the results don't lie. Most people fail terribly at it. And I'll give you a quick example of just how poorly the average investor does when they try to time the market. If you look at a 20-year period from 1994 to 2014, the S&P returned 10% annually. For that same period, the average investor only got a 2.4% return on their investment. How does that happen? Market timing. This is something that destroys the average investor's return. Market timing. Why can't people just be happy with getting a 10% return? I'll tell you why. Because that doesn't sound sexy enough. People want to be able to say that they got the 1,000% return because they bought Apple at a low and they're selling it at a high. That is the exciting part that we hear about investing. But we believe strongly in practical, consistent investing. And getting 10% annually on your investment, those are tremendous returns because of the power of compound interest. So when you look at someone that invests over a long period of time, when they are not timing the market and they are consistently sticking to a simple investment plan, if they can get 10%, they are doing excellent. And that is exactly what we did on our journey towards financial independence. we stuck to a plan and we got the average returns in the market.
And we really want to emphasize this because yes, you may have one year where you have a fantastic return because of market timing, but can you do that every single year? Can you do that for 20 years, 30 years? 50 years. You know, financial independence is a lifelong journey. If you are retiring early, you need to have a portfolio that will consistently sustain you throughout your retirement and beyond so you don't have to go back to work. And for you to do that through market timing, you have to be able to consistently time the market year after year after year.
But of course, don't take our word for it. Do your own research, and we always do our research whenever we make these videos, and especially when we do our investments. And so we want to point to another source of data that talks about the consequences of trying to time the market.
So we're going to introduce a study by Merrill Lynch that focused on market timing. So this study looked at the growth of a $1,000 investment in the S&P 500 index fund when the investment was made in the beginning of 1989, 1999, and 2009, and then it ended in 2018. So it compared portfolios that engaged in market timing to portfolios that simply invested the money and never touched it. So in each scenario, it looked at the effects of an investor missing out on the top performing months in the stock market because of failed market timing.
Now let's just marinate on that for 1 second. This study found that by missing out on the surges in the market, you miss out on huge returns. You see, what typically happens with investors is they see the stock market going up and they say to themselves, this must be the top, it's time for me to pull my money out. The market can't go any further. And so they pull their money out only to see the market go even higher. There have been over 1,000 all-time highs. How can you identify that this is it, that it's reached its peak?
So that's what the Merrill Lynch study focuses on. It focuses on missing those all-time highs and the results that it would have on your portfolio. So here are the results of this study. For someone who invested only $1,000 in the S&P 500 in 1989 and never touched that investment, they would have had $17,306 in 2018. If they invested $1,000 in 1999 and never touched it, they would have had $2,985 in 2018. And if they invested $1,000 in 2009 and never touched it, they would have had $3,530 in 2018. So what's really interesting is when you look at that untouched money and you compare it to people that are trying to market time. So let's look at 1989 to 2018. If someone invested $1,000 in 1989 but tried to time the market and missed the top 10 performing months during this 30-year time period, that person's investment would only be worth $6,959 in 2018 compared to the $17,306 return on the money that remained untouched during that same time period. And if that investor missed the 20 top performing months during that same 30-year period, that portfolio would only be worth $3,328 in 2018. So if you look at the other two time periods, the results are similar.
So this study, like many other studies, illustrates an important part about investing. It's not about timing the market, it's about time in the market, how long you are invested in the market. Because just by missing a couple of months, or in this case, 10 months over a 20 or 30-year period, it can significantly impact the return on your investment.
So this is a perfect segue into the 4 different ways that market timing can really sabotage your portfolio. And the first one is you are missing out on income. So when you are selling your investments, you are out of the market and you are not collecting that dividend income or that dividend payment from your investment.
The second problem with market timing and jumping in and out is that every time you go to buy and sell, you are paying fees, and that is a drag on your portfolio. And the third way you are sabotaging yourself is that every time you sell, you may incur taxes. And we talk a lot about optimizing your portfolios so that you minimize your taxes. And by constantly buying and selling at a profit at possibly the wrong moment, you will be paying extra taxes.
And the fourth reason, and I really think this is probably the biggest way to sabotage your portfolio, is the emotional toll that it takes on you. Aman and I love the lazy portfolio, putting our money into our portfolio automatically and not having our emotions associated with our portfolio. But with market timing, you have this anxiety. You're trying to figure out the swings. You're checking the market every single day, and that creates a lot of anxiety and emotional toll with your investment portfolio. So if you haven't guessed it already, we are not proponents of the market timing strategy, but we do have alternatives to market timing. And the first one, we always talk about this, is have an investment plan. You should have an investment plan before you begin investing, and you should stick to that investment plan throughout your portfolio's lifetime.
Now, the reason why a plan is an alternative to market timing is because the plan provides consistency to you on your investment journey. I am always surprised to hear about so many people that do not have investment plans. I personally think you should not buy a single investment unless you have a plan in place. Because when volatility comes, and it will, it's a plan that keeps you grounded and focused on your financial independence journey. When you don't have a plan, you tinker with your investments. And when you tinker, you lose money. Now, the second thing is make rebalancing a part of your plan. Now, don't get it twisted. People will often use rebalancing to time the market, but rebalancing is something that is very planned out. When you rebalance on a schedule, what you do is you optimize returns and you minimize risk. Let me say that again because I just love the way it sounds. You optimize returns and you minimize risk when you rebalance.
So we're not going to go into detail about rebalancing because we do talk about that in our course, but rebalancing is a great way to create consistency, to do it on a schedule, and to really avoid those market timing urges. And the third alternative to market timing is dollar cost averaging. This is our favorite technique in terms of investing in the stock market. Dollar cost averaging, where you're putting your money into the market regularly at fixed intervals throughout a prolonged period of time.
And this is exactly what we're doing with this portfolio. We put a large lump sum of money into the market, but we continue to add to it on a consistent basis. Every month on the 15th, we buy more shares of our stocks. And sometimes we're capturing a low and sometimes we're capturing a high. But what we're going for is the average. And the average over a long period of time, that is what we're going for. So this segues into us talking about the performance of our portfolio for this month. So let's get into our results.
So the first stock is Fidelity Zero Total Market Index Fund, FZROX. On June 15th, we invested $720 and bought 66.667 shares at $10.80 each. We now own a total of 563.972 shares at an average price of $9.17 per share. Our total amount invested is $5,170.19. The current value as of June 24th is $6,214.97, making this a total gain of $1,444.78 or 20.215%. The next index fund is the Fidelity Zero International Index Fund, FZILX. On June 15th, we invested $240 and bought 25.97 shares at $9.24 each. We now own a total of 212.661 shares at an average price of $8.09 per share. Our total amount invested is $1,720. The current value as of June 24th is $2,022.40, making this a total gain of $302.41 or 17.58%. And our last fund is the Fidelity Real Estate Index Fund, FSRNX. On June 15th, we invested $240 and bought 17.6 146.518 shares at $13.70 each. We now own a total of 146.203 shares at an average price of $11.83 per share. We also received a dividend payment this month from this index fund for $8.96 that was reinvested on June 5th and that bought 0.618 shares at $14.50. Our total amount invested is $1,728.96, and the current value as of June 24th is $1,925.49, making this a total gain of $196.53 or 11.37%. Overall, our portfolio as of June 24th is valued at $10,162.86. That's up $1,543.73 or 17.91%.
$10,000. I love it. So this is a special month because our portfolio broke $10,000. It just has a nice ring about it. But next month, the stock market could be down and we could have less than $10,000. But that's okay because that means we can buy more shares at a discount. You see, over the long run, we know that we will get the average return in the stock market, and we're okay with being average. So, if you like this series, please subscribe to our channel. And as usual, if you like this video, give it a thumbs up, subscribe to our channel, and join the journey.